my background is in trading and how I got to this point, and it's sort of a series of stories, and I'll try to be brief with it, but basically I started trading actively in 1991. I haven't been trading full-time all this time. Took a long break, and I'll tell you why, but when I first got into trading, I had been involved in real estate. I actually was buying foreclosures after watching some of those late night guys on TV. And I wrote a package for a computer package that would help me evaluate properties and place bids. So I could go through a whole bunch of listings all at once and basically kick out a whole bunch of bids and get back people who were interested instead of trying to, negotiate and figure out what everyone wanted and stuff. And I started reading about the markets and figured, if I can do this stuff with spreadsheets and all that for real estate, I should be able to come up with something that will give me a market edge kind of situation. I was looking at spreads back then, commodity spreads and stuff, and I knew nothing. I knew nothing about the field. I knew nothing about work that had been done before this, but before I came to it. And I was in Manhattan, and I went to the technical analysis bookstore on the Upper East Side and bought a couple of books, and wow, they're trading magazines. I didn't know that. That's really interesting. So I bought a couple of these magazines, and wow, I didn't know there are computer programs already that do this kind of stuff. Isn't that amazing? I'm not, breaking new ground. So I did some research, and I bought this program called the Right Time System. I don't know if they're still around or not, because it looked really great. It told you, it scanned through a whole bunch of commodities and stuff, and it said, here's the low, buy now and sell now, and it had a backtesting module, and it showed you how well it did. It's just fantastic. So I loaded this up on my computer and started to smart enough to start to paper trade it instead of actually getting in there with money, because I wanted to see how this thing did in real time. So it was great. It said buy here, and I wrote down, okay, I bought here. Well, then the next few days the market went down, and the program said, oh no, I really meant buy over here. It's like, okay, went down a little bit more. It said, no, there's no buy trigger. Forget it. Buy is negated. So it kept doing this kind of stuff, and I realized, pretty quickly that this whole backtesting thing was only on the signals that it finally said, the last place to buy and the last place to sell. And if it said the trigger was no good, it didn't record that in its backtesting. So it was sort of like, kind of back adjusting its results. So that was my first introduction to the land of gurus. Who kind of doctor what they're talking about. Did a little bit more studying. I like to give credit where credit is due for everything that I am doing at this point. I started studying with Dr. Alexander Elder, and he introduced me to the idea of multiple time frame trading, where you're basically looking for a shorter term trend to rejoin a longer term trend. And he and I became friends, actually, and I started trading the S&P 500. Back then it was $500 a point. It was, the big contract. There was no mini. There was no $250 a point. It was pretty pricey to get involved in, but it was nice and slow because there was no electronic trading. And it was so slow that what you would do is, some of you probably were around back then too, but what you would do is you would make your decision. You had charts. I had this big FM receiver, no internet, no such thing. It's a big FM receiver and this powered antenna, and it would get the quotes over some sort of sub-frequency on an FM station, and poured it into my computer, and it was nice and gradual. And you'd make your trade, you'd pick up the phone and call the order desk and place the trade and hang up the phone, and they would call you back in 90 seconds with your fill. That's when you would place your stop. And those of you who are familiar with intraday trading now know how different that is. Now we're talking about light speed execution and bracketing, or entry software that places places your stop at the same time. You have to do that because things are so rapid. So I did okay with that. I did really well, and I started managing some money. And I hated that. I really hated that, and it soured me completely on trading because, again, it was pre-internet days, and some of my investors were sort of they wish they were doing it themselves, so they used to call me at the end of the day. And they used to say, how do we do today? How do we do today? And of course, every trader has down days. That's how it is. So what would happen is I got trigger shy. I found myself in an emotional bind where I could not make a trade because I dreaded the idea of having a down day and reporting that to these people who are looking forward to a positive report. And that's all in hindsight, how I'm analyzing my emotional response. When you're in the middle of it, you don't really know necessarily, or at least I didn't, what was affecting me every single second. So I backed away. I backed away from it for several years and got involved in other things. Got back into it about 6 years ago. And I was really interested in going off and doing other stuff. And it was my family who said, well, you have enough money to get involved in this, and you did so well before. Maybe before you make this drastic step into a new career direction, maybe you want to get back and take a look at that. So I did. I figured I'd get into it. Did so well before. Has to be just as good again. But now they have this thing called the minis. So, let me check that out. And I really didn't feel like I had enough money at that point to focus on longer term trading. I wanted to manage risk that you have with day trading. Well, I got my charts together, and it was sort of like the difference. The S&P might have been more money back then, but that was sort of like driving a Yugo. And as far as the speed capability and the acceleration, the minis, even a few years back, it was sort of like you got into a Ferrari and floored it. Whatever it was I was using as a decision-making process back in the early 90s, boy, taking a break from it really shows you how your trading methodology has to evolve with the markets, because it was totally different, completely different. That idea of hundreds of dollars every second that you can make or break you. The principles I learned from Dr. Elder about the multiple time frame stuff worked out. But I still use the same concepts today. I mean, it's the same sort of stuff that Robert Kraus taught with Fibonacci Trader. But the decision-making process had to be streamlined. And the indicators that I was using then, really, I couldn't interpret them fast enough to keep up with the markets. And I started losing money. And in all honesty, I can say I did not blow an account. I never blew an account. But I took my initial account, my initial amount, down to less than a third of what it was. That was my tuition, period. And I was frustrated, and I went through just about every emotional up and down that all the rest of us go through with this. And I went through grail seeking, and I went through, then I realized that there were a lot of resources on the internet also. And I hope this isn't boring anyone, but I kind of just want to let you know where I'm coming from. Thanks. So I realized, there's all these net resources, and I got on forums, and I really wanted to learn from my fellow traders. I couldn't even call myself a trader then. I really didn't feel entitled to call myself a trader. I was it felt like a permanent drawdown. It's just, I was not even treading water at that point. So let me see what's going on. And heard all this great stuff about Woody, the Woody CCI. You guys all know about Woody, and his CCI work?
Oh, well.
Yeah, and Woody, I learned a lot in that room. What I didn't learn was how to construct a trading plan, and I also, I think probably they're a little bit more structured now in telling people like what's a trend trade and what's a counter trend trade. I remember having a day in Woody's room where the market was really choppy, and I was using CCI trend line breaks. Everyone know what that is if you worked with Woody. And I was like, wow, you know what? I solved it. I can make money with this because the market's doing this and CCI is doing this, so you buy when the CCI breaks. Buy or sell. I made money that day. Tried the same thing the next day, but that was a trend day. Okay, still something missing, I guess. And I actually formulated, I did get involved in writing my trading plan at that point. I felt like I had enough information about how the markets are moving, and for my level of understanding, there were a few essential things that were missing from what I was learning in Woody's room. The targets and stops seemed arbitrary to me, and identifying whether we were in a trending phase or a consolidation phase was almost impossible for me, just by reading the CCI. There are other people, I became friends with several of the Woody's moderators. Gio, for instance, a very good friend of mine, she has a method of looking at multiple time frames just with CCI. She's doing other stuff now, but she has a way of incorporating that where she can trade just with the CCI. Woody himself can trade with the CCI. When he's alone, I mean, it's very difficult when you're talking to a whole bunch of people and missing stuff, whatever, but he's looking at other time frames, I believe, and coming to conclusions based on that. Whatever I was learning there wasn't enough, and I was still hanging out in there, and he had Carolyn Braun come in and do a presentation on her fib work. Well, I had taken fib courses before and looked at it, and fib always seemed to me to be really interesting in hindsight. It always looked like, that's great, market went up and you draw this retracement thing, and it broke here and it broke here, and that one, wow, that one really held. The question is, of course, how do you know which one's going to hold and which one's going to break? That's how it always is. So it always looked great to me in hindsight. I actually took a class from a guy who would fudge it also. He would say, every time you hit one of these levels, this is where you should buy, and oops, no, that's where you should buy. So that wasn't too cool. Carolyn taught me a lot about clustering the fib levels and coming up with the strongest possible Fibonacci support and resistance. And again, I like giving credit where credit is due. What Carolyn could not talk about really and can't address is triggers and trade management, because that's just not where she is. She's strictly into the analysis based on the fib work. And I was taking a lot of the stuff from the Woody perspective and using the CCI to trigger with Carolyn's work. I did well. That was when I started to do better than treading water. Basically, do better than treading water. And I met some of the Woody outcasts who were experimenting at that point with the 50 CCI. Longer term, Woody only uses the 14 and the 6. And I became friendly with them also, and it was an interesting path, because I was just a chat room member, and because I became associated with Carolyn, I went to workshops and worked with Woody and witnessed a lot of the drama that you guys may have heard about if you know about the history of Woody's room. And so then there were some of us who were not really welcome because we dared to talk about the 50 CCI. And the 50 is just a lot smoother. It's a longer period CCI, and it's a longer period moving average, essentially. And I worked closely with, I know a lot of you have met, we even did a Fibonacci Trader workshop together, Denise Acosta. We developed a multiple time frame approach to using the 50 CCI. And a lot of that input was hers, and I brought the Fibonacci stuff into it. And when we put together the multiple time frame approach combining Fibonacci and CCI, we both kind of went, wow, okay. We actually had some trading accidents when we were sitting right next to each other at my house. We were trading together, and there was one time when the Russell was just plummeting one day, and I had projected an extension for the low of the day, or I thought it might have been the low of the day. You can't tell if it's going to hold or break. She and I got into talking about something else, and then she started having a fight with her mother on the phone, and meanwhile her stops had been, and this was like 7 points away. It was really whatever. So just to have our last exit on the trade, we had planned to adjust it and bring it closer. She stuck the exit down at that extension, and it hit to the tick and bounced. And we actually got the entire, it was just fantastic. And that used to happen when we worked together over and over, that we'd have these moments where it was like, wow. And so then I went from my equity curve, that had been doing this and then this, did this. Okay. Now, it works for me. It works for me. Does it work for everyone? No. There ain't no grail. It's not made of stone, it's not made of silver, it's not made of wood or clay. It doesn't exist in this field. Trading is like any other business. If you, I don't care if you're trading long-term stocks, long-term metals trades, intraday trading, intraday scalping, doesn't matter. It's just like any other business. If you owned a store and you had to decide on your inventory, it's what you're doing when you're making a trade. You're investing in a piece of inventory. Once in a while, you're going to be the store owner who's going to buy that silly battery-operated thing that whirs around and ends up, smacking the kid in the face, and no one else wants to buy it. You're going to have 1,000 cartons of it in the back, and you wish you would have gone short that instead. That's what it is. It's just a business investment, and no business in the world allows you to make profit on every business investment. So one of the things, I mean, that's partially trading psychology. One of the things is you have to be comfortable, just like you have to be comfortable as a store owner with your business plan, you have to be comfortable with your trading methodology and your trading plan, because you're going to have some trades go against you. Now, does that mean that accepting that information that what I'm doing should work for everyone? No. No. This is what calls to my eye. This is what works for me. You got to find what calls to your eye, what rings out and says, I understand this. And this trade is something that I can get into. These trades, something I can get into with faith and confidence. Not even faith, but confidence. I can do the best I can do to show you how this is done. And I suggest that you practice with it. If it does call to you, if you take one look at what I am doing and you say, fat, bleh, it's awful, that's okay. In other words, if it doesn't call to you, if you can't understand what I'm doing, you don't want to understand it, there'll be something else for you to accept as a trader, and I won't be offended. I'm here to answer whatever questions I can about this methodology. And I think, I mean, there are some people in the room who've worked with me for a while, and they've seen that this is profitable, and it's going to be profitable for them as well. So hopefully, I'm just giving you that part of it because I'm saying, not promising you a grail. I'm not bothered if you've tried this and it doesn't work for you. I know it works though. I know it's profitable. So, with that, what are we doing?
How often is it profitable?
How often is it profitable? I mean, like,
What percentage?
Well, this is a discretionary trading methodology. So that's difficult to say because it kind of, how often is it profitable for me? 70%. 70% of the time.
Very good.
You know, Jeff, when you say we're about that in the room?
I would say so.
Yeah, we do that. We have a chat room, and we do trades. We're trying to phase more into longer-term trades. We still have a lot of people, myself included, who are interested in the short-term index trading. We're always looking at longer-term, at least intraday swings in gold and bonds, and if we have time, I want to get into a couple other things. We're trying to phase away from some of this, finger on the trigger, do we get in or not, kind of stuff. But it is discretionary. That discretionary doesn't mean that there aren't rules. There are definitely rules about it, but this is not something that can be automated because the fib work is done manually. But we are looking for very specific triggers, and there are specific rules to the trade management. But I think we're doing, there are some days when it's more like 20%, right? There are some days when we only have 2 trades and it's 100%. But really good trades. but overall, I think we're going between 65 and 70, I would say. The stock trades we've had recently, though, are more like...
They've been 100%?
Well, except that LVLT is kind of... Yeah, well, it did a Gartley now. Okay. So, yeah, that's the one bad one. And we had, at our bond trades, we've had one bad one in the last month. But they don't set up every day.
Don't you look at them and you can probably tell, if you back test them a little bit, you can tell this seems to be acting pretty good, so.
I can't back test.
You can't back test.
I can back test the triggers, but if I were to back test, a lot of our decision-making process is based upon the Fibonacci work. And our Fibonacci work is done manually. So we would have to actually go, I believe in, I forward tested. Basically everything is forward tested constantly because we're keeping trading records. So, we can, if you want, one thing people who start working with us will do is, I tell them, don't worry about the back testing. A lot of people ask, can I back test this? I'm like, well, if you want to go back in time and forget about everything that happened here and do the fib work manually on old swings, yeah, you can back test it. But you're better off building confidence by learning the methodology and applying it going forward and paper trading it.
You say you do it manually?
The fib work is done manually. Yeah, using the tools that I showed you yesterday, and then we'll get into today.
Okay, Mark, so you hit 65 to 70%. I have to ask you, what's your risk versus your reward on these?
Well, it depends on the time frame and the type of security as well. That's
an average.
What are you interested in trading, or what do you trade here?
I trade long. I trade a week to a month on a portfolio of 30 stocks right now. I did pretty well.
Okay.
But I want to learn how to day trade the indexes SPY and IWM. I don't do too well on those.
Okay, why, I mean, I'm curious as to why you'd want to trade the ETFs instead of going for the like a contract, like the S&P or the Russell, because IWM is...
Oh, I just used to trade back in the 80s and I lost money in the futures.
But
I haven't traded since.
Yeah, trading the IWM though is trading the futures, essentially. I mean, you're trading the Russell, but you're paying more commission.
No, $10 in, $10 out.
That's a lot more than what we're paying on the Russell by a factor of 4.
Yeah, I own 5,000 shares or whatever.
Okay, well, if you're comfortable with it, that's great. I really was just asking. I'm not saying you shouldn't do that. I was wondering what the benefit is to doing it that way. The risk reward factor, when we get in like our Russell trades, my initial stop is 1 point on the Russell, and that's $100 per contract. Okay, and if it turns into a scalp, in other words, if we get a little bit of a profit and it turns out that it's
You're
time to
trading
get
the
up.
future, so
Yeah.
I'm trying to...
That's why I'm asking you what you're trading, because it's kind of hard to translate it to that.
Like 84 to 0.00, how do you get in and risk, I don't know, 20 cents or whatever?
Well, we would place our stop on the other side of our support cluster, for instance, if you're buying. So basically you can determine your risk reward, because if you say the stop has to be too far away for the rhythm of the trend to maintain, yeah, it's not worth it. If the target, I mean, that's something we look at in the chat room with the futures all the time. If you have a target, if you have a lot of the fib stuff saying it's going to stop here on this rally, and you have to place your stop here, and price is here right now, it looks like, it's not worth it. So the risk reward factor is kind of up to you. And it's the same way with the stocks. So that's what we're here to talk about, Fibonacci and CCI. The Fibonacci work, of course, to me the Fibonacci work is the core of it. If you don't like CCI, you can take the Fib work and take these same principles and use a different oscillator. If you'd like. Some people use moving average crossovers for triggers and trade management. Some people use stochastics. As I mentioned yesterday, I'm kind of interested in comparing triggers with Dennis's stochastic, Dennis Bowles' stochastic. He's going to be here tomorrow, by the way. Bless you. I like CCI. It works for me. It's something, having been through a lot of indicators, having had too many indicators on my chart and throwing them out one by one or throwing them out en masse, it's the one where finally I'm like, hey, I can read that. That makes sense to me. What are we doing? Staying on the right side of the trend and entering and managing trades with the Fibonacci and CCI stuff. And as I mentioned, I don't have a whole big workbook here because we're going to work on building the workbook together. If we don't have enough time today to get into everything, we have, Chris is going to talk about his stuff tomorrow. We're going to both be able to talk about a lot of the details as we have live markets to deal with on Monday and Tuesday. And if there's something, this approach is multifaceted. I don't want to give, a shortcut approach to any of this. So we're going to focus on some of this price work at this point, and we'll get into the timing, because I know there's some people here who are really interested in the Fibonacci timing. If we don't have time to cover enough about the timing, we will make time. Even if we have to get together, anyone who wants a timing intensive one of these evenings, we'll do it that way. Or we'll spend a couple of hours on that on Monday or Tuesday. Whatever we have to do. What kind of trend is this? Is this uptrend, downtrend, flat? Uptrend? Okay. If you guys skipped ahead in the workbook, you probably have the cheat answer to this. But, okay, first of all, what makes it an uptrend?
Well, the lows are higher.
Okay.
Highs and higher lows.
Higher highs.
There you go. Higher highs and higher lows. Okay.
And the 50 CCI to maintain above 100.
Okay, that's cool too. Definitely. All right. So, what about this one? Downtrend? Okay, why is it downtrend?
Each low is lower.
Lower lows and lower highs.
And 50 CCI.
Yeah, it just broke above that minus 100. You know how to read your CCI, that's for sure. And we're below the 34 EMA. I like to use the 34 period exponential moving average. I just find that it complements the CCI really well. Are you guys, do you have any idea why there's no price information on this chart or the last one? Because it's the same stock. It's the same stock. It's just that this is daily and this is a weekly.
Oh, wow. Okay.
And that's why we look at this stuff on multiple time frame. Because as you'll see in a bit, if we were to run the fib work on this, those who are just looking at the daily chart may be due for a disappointment. And we always base our trading decisions on what's happening on at least one or two time frames above our execution time frame. We want to see, let me go ahead with this. We want to see when the shorter term trend is rejoining the longer term trend. Our goal is to buy short-term dips or sell corrective bounces in the context of the longer term trend. That's when the trades are smoothest. When you have, let's go take it down to intraday, when you have a 15-minute uptrend and you have that determined, you have that delineated by our fib work, you have a 15-minute uptrend. Our buy is when the 3-minute is in a decline and then starts to rally again, begins to rejoin the uptrend, begins to rejoin the 15-minute uptrend. The same thing with the stocks. Why is that? That was Sirius Radio, by the way. That's why that Sirius Radio was not the most exciting buy at this point, because it looks like it's kind of likely that we'd be more interested in looking at when the downtrend on the longer term is going to be rejoined. Because the weekly is going down. Weekly is going down. Likelihood is, we don't have any proof of this at this point, we have no triggers on these charts. The better trade for us, though, on this will be when the downtrend resumes, than trying to fight this downtrend by buying. Leonard, is that making sense?
Oh, yeah.
Okay. We use Fibonacci price analysis to determine longer-term trend. Longer-term trend is the next higher time frame, at least, than our trading time frame. So in other words, as I said, we have a 15-minute chart that's a clear uptrend. We're not trying to pick a top just because the 3-minute starts to go down. We're waiting for the 3-minute to come down to closer to the 15-minute support. In other words, our shorter term. What I'm saying is we're executing off the 3-minute chart, for example. Support on the 15-minute. 3 minutes doing this off a top. Are we shorting? No, we're waiting to see what happens at this 15-minute support. Because most likely, the short-term trend is going to rejoin the longer-term trend. And the buy here is going to show more potential, more oomph, less chop than that short. Yes,
And you're looking at, you're only looking at those two items when it comes down to that 15-minute. You're not looking at anything else.
Well,
see what else besides your weekly, you know. And
it depends. Okay, for instance, on a daily chart, if we're talking about an investment that's on a daily time frame, whether it's,
we're talking about real time now. That's what you're. So.
Well, I'm talking about the concept of at least 2 time frames, no matter what you were trading, what you're trading, what your time frame is. In other words, if you're a swing trader, 1 to 30 days, let's say, on a stock. On stocks, you're going to look at the daily for your executions and immediate trend, and you're going to look at the weekly. Okay, if you're an intraday trader on the S&P, the ES, you're going to look at the 15-minute and the 3-minute, for example. 15-minute and 3-minute. But you're also going to look at the daily, of course. You're going to look at the daily on that because there may be a major target coming up on the daily that will just get right in your way. We're going to get into all that stuff, but the concept itself is our entries are when the shorter term trend is rejoining the longer term trend. Okay? Is it dry in Vegas or what? Because I think I've gone through about a gallon already today.
Pretty dry.
And pardon me for having these slides on the side, I just find it easier. What I generally do when I'm doing these things is I keep collapsing my PowerPoint and going to live charts to show examples. This is that Sirius Radio. How great does the uptrend look now? The longer lines. This is why I have remember the fib tools I showed you yesterday? This is why I have them set up this way. I don't like that one. Because the fib tools, the way I have them established, you can immediately, just at a glance, get an idea as to the relative strength of our resistance versus support. Because the resistance, you see how the lines are longer? See how the lines are longer horizontally? The heck with that. See what I'm talking about? Yeah, they're longer because the resistance has been in place for longer. The resistance is based on measurements down to this low. At a glance, you can tell just by looking at this chart that we're building support. Our support levels are just this big. We're facing all this stuff though. And that is a lot to break through in order to have a successful long here. Successful long workout over the longer term. So that's, just an example of the kind of work that you can do on the charts that I opened up with using the tools that I showed you yesterday. What do all these levels mean? We'll get into it. I think I should do this. Okay. Anyone who wants to be able, my goal here is anyone who wants to get started with doing this kind of work on their own charts, you should be able to. I want to be able to make sure that I convey enough about this stuff that you guys can at least start working on your charts with it. You can also email me charts, if you decide you really like this stuff and you go home and you work on some charts and you're like, I don't know if I did this right, take a screenshot, send it to me. I'll take a look and email it back to you with some comments on it. My whole point in saying this is the big but at the bottom. Every time I've done one of these workshops, I have talked about all the fib work first, and it's all been very hypothetical seeming because we haven't talked about any kind of trade triggers. By the time I get to the CCI stuff, everyone's eyes are glazed over. Okay, I really had to realize this when I was working on putting this together. What's been wrong in the past? Well, what's been wrong is that by the time I exhaust everyone with the fib stuff, and they're like, huh? You got more you got to talk about? I don't know. Let's talk about the CCI first this time. Okay, is that all right with everyone?
Yes.
There are 4 main CCI triggers that we use. Four major entry triggers. And we'll get into the trade management stuff when we have probably more so when we have live charts to look at as far as the CCI exit signals. The triggers that we use are not the Woody CCI patterns. They have nothing to do with the Woody CCI patterns at all. Okay? One of the things, again, this is not a criticism of Woody, but one of the things that I found confusing about that room is there are about 127,000 triggers? If you guys, it's kind of like, there's a lot. And there's a lot of really, really specific rules to each one. This one has to go this way and that one. For some people that works perfectly. We just have 4. And the first one, let me see what else I have here. Yeah, well, here's some basic information about CCI. Commodity Channel Index is a detrended moving average oscillator. Okay, some of you heard me say that before. What the heck does that mean? Just means that all the CCI is the 50, for instance, is a 50-period simple moving average that's made flat. Instead of following along with price and doing this stuff, it's flat. It's the 0 line on the chart. Okay? In other words, any CCI, the 0 line itself is the moving average. The line that does this is the average of each price bar. It's made to move up and down across the moving average instead of the moving average moving around with price. The advantage of detrending it that way is that you can more clearly, or I can more clearly see how price is moving in relationship to that moving average instead of going like, well, it's an uptrend but it's crossing down. It just sort of, it removes the concept of trend from your oscillator decisions. It just makes it a lot easier to spot patterns that way. It lags though. Some people tell you CCI is a leading indicator. No. How is that possible? How is it possible that an indicator based upon current price action is leading? What is it? It's a precognitive indicator? It should be like in Psychic Magazine or something? I don't think so. It's a lagging indicator. But the Fibonacci work is leading. The Fibonacci work is leading because it's based on analyzing recent price action and projecting into the future. If the trend is going to continue, this is where it will do this. It is a leading indicator. By combining these things, combining the Fib with the CCI, works out great because it tells us, CCI tells us, yeah, momentum is going to respect your forecast. That's all we're doing here. You're forecasting what has to happen for the trend to continue or reverse. And CCI says yes or no. Trends continuing, trends reversing. Because we look for what CCI is doing as we're approaching our fib work. That's what we're going to get into. Settings we use on our CCIs: 50 period, 14, and 6. Okay? Guys, you can scribble in your books too, because I'm going to talk about a lot of stuff that's not in that. You got notepads. So please, make sure that you're aware of some of these details. This is in the book: 50, 14, and 6. The reason I'm stressing this is because I'll have a lot of people who tell me that, well, I'm not getting the same triggers as you are. Well, are you using a 50? Oh, I didn't know it was supposed to be 50. That's what we're using: 50, 14, and 6. Only difference is on a daily or higher time frame chart. Replace the 14 with a 20. Okay? Really simple why we're doing that, because sometimes on a daily, you can have one of these really elastic candles, where you have the wick or, whatever is all the way out here. Because we're dealing with the average on the, the CCI is the average of the entire candle. We want to smooth it out a little bit when we're dealing with daily or higher. So we just switch to a 20 period. Now we can get into the triggers. I forgot the sequence in my slides. Okay, this is what we call a 50-34. And 50-34 just means, I really should have made these moving averages darker. I didn't realize it wouldn't show up that well. Can everyone see the light blue line, the 34 EMA? Can you guys see that? You have the printout anyway, it's probably shown up there.
It's 34.
Sorry?
It's a 34, you said?
34 exponential moving average.
Yeah, they come out darker on the paper.
They came out darker there, yeah. Okay, thanks. 50-34 is simply the 50 period CCI is crossing the 0 line, and price is crossing the 34 EMA. That's all that is, 50-34. Do they have to cross simultaneously? No. Do they have to cross within some magic number of bars of each other? No. You just have to have a cross. You have to have price actually crossing the 34 and the 50 crossing the 0 line. That is a change in trend. This is where you might want to start taking notes a little bit. The 50-34 is a change in trend on that time frame. That's the main trigger. A lot of people just use that. Okay? 50-34. Next. Okay, this one we call the 50-34Z, which is an homage to Woody. Not an ode to Woody, that sounds like a bad country song. The Z stands for zero line reject. And what this means is the 50 has come down to test the 0 line and rejected it. Okay? It's rejected the 0 line. Here. Came back up, attempted to test that resistance at the 0 line, which is actually, remember, our 50 period moving average, and rejected it. Now, what are the nuances to that? The 50-34Z has to occur after a 50-34. Because what you're actually seeing is, see this 50-34? Price crossed below the 34 EMA. 50 crossed below 0, that's a 50-34. It attempted to retest the point of breakout. In other words, it broke support, went back and tried to retest. So that's 50-34 and then Z. Rejected it. The actual mechanical trigger there, how do you know when to get in, is, this is one of the few places where we use the 6 period. The 6 period is this light yellow line. What you want to see is the 6 period touching or dipping on the other side of the 0 line and then rejoining the 50. When the 6 rejoins the 50, it's saying, you know what, short-term momentum is confirming that it's not going to go against you. It's not going to go to the other side of the 0 line. Short-term momentum and longer-term momentum are all lining up in the same direction. Okay, so that's the mechanical trigger there. That's the only real thing to understand about these 50-34Zs. You had a 50-34, and now you have a retest, and just for the sake of having a mechanical trigger and not going, I mean, this was a problem also we had in Woody's room. He has the ZLR with the CCI rejecting the 0 line. When is it actually rejecting it? When is it doing it? How do you know it's rejecting it? It's rejecting it when the 6 crosses back and rejoins the 50. That's all. That's when you push the button. Any questions on that? Yeah, Leonard, one second, Leonard, I think you're... Okay, I wasn't looking at hand sequence, so...
Okay. I was going to ask you, there's two. This is the Woody? This is the Woody's, the regular, the CCI, on the bottom two? Are they the same thing?
Oh, what you're seeing here...
What I see here on the chart is
I'm sorry, you're right.
I see two different...
Okay, no, Woody has nothing to do with this. Let's forget about that for a second. I'm just referring to some of his triggers in comparison. Woody has nothing to do with what you're seeing
I
on
know
this
what
chart.
50 is.
I'll tell you what you're seeing. Okay, because you're right.
We're not there yet.
No, well, I went over this chart a little bit yesterday, but I'll tell you now what you're seeing here. This is Fibonacci Trader, so
Okay.
it has multiple time frames on one chart.
Right.
This is my main Russell trigger chart, Russell Intraday trigger chart, 500 volume and 1,000 volume. You see these time frames up here, 500 and 1,000. So what you're actually seeing here is the 50, 14, and 6 on the 500 volume time frame, and the 50, 14, and 6 on the 1,000 volume, all on one chart.
The 50, 14?
And 6. Both of these, Leonard, both of these are 50, 14, and 6. It's just this one is on 500 volume data, and this one is on 1,000 volume data. Okay? Because we only take trades in the chat room when these are in agreement, when they both trigger. That's why this losing trade up here, this is a loss. This guy up here, I just had it up because it was an example of a 5034Z. If you had taken this long trigger, didn't get you very far, but it was not in alignment with our higher time frame, so we didn't take it. Okay? This was perfect. This we probably made money on that, Jeff. Hey, worry.
No, it's fine. My question is answered. Thank you.
Oh, okay, sure. Okay, any other questions about the two we've covered so far?
Yeah. Your 5034, you used the red line. If you go back and look at it, it's just the red line that crosses the 50 CCI. But in this one, you use the 6.
Right.
Right there.
Yeah.
Okay.
Yeah, the 6. The reason we stuck the 6 in there is to have a mechanical trigger, because that's why I brought Woody into it, because Woody and some of his people who followed him for a long time, they can look at one of the CCIs and say, that's a ZLR, that's rejecting the 0 line. I couldn't do that.
Okay.
And a lot of other people couldn't do that. We would say, well, is it going to reject or is it not going to reject? The answer to us is when our shorter term CCI is rejoining the longer term, then we know momentum's going that way. And it's actually rejecting the 0 line. So we stuck the 6 in there as a confirming factor and as a place to push the button. Because otherwise you're going to sit there and go, well, I don't know if it's really triggering or not. 6 does this. Push. That's it. Mechanical.
Mark?
Yes.
One question, and we might not do it for other reasons, but if you have the 50 crossing the 34, and then you crossing 0 with the 34 going down, then it comes back up, then it comes down again several times. You probably have a flat 34 EMA, but are those considered triggers?
You mean like if you have multiple 5034Zs? Yeah, they are.
I mean Zs, but even 5034s.
Yeah, but you better look at what's happening on the higher time frame.
Right.
Because you're talking congestion then,
Right.
caught between, yeah.
Right.
That's one thing, we're going to get into that, but as Jeff just reminded me, and as I was mentioning here about this not being a trigger for us, we only take these when they show up on more than one time frame at a time. You see, and when I go through the other two triggers, you'll understand why. We're not sitting there and going every time it gives us one of these little deals, we're in and out. We need to see that each time frame is telling us something. And that keeps us out of a lot of trouble. On I don't care if that's a daily stock trade or a trade that you only expect is going to take 5 minutes intraday. We still look for multiple time frame triggers because if the market's chopping, you're not going to get them. Third trigger. Anyone have a guess?
14.
Thank you. 5014. 5014. The 5014 is simply that the 50 is on one side of 0, okay? The 14, which is the blue line here, crosses above 0 in this case, because the 50 is below 0, this would be a short trigger, to the opposite 100 line. In other words, here it is at the plus 100 line. and rejects the plus 100 line and crosses back down below 0. Okay, the 14 goes all the way to the 100 line or above is fine, and crosses down below 0 again. That is an extended correction within a trend. That would correspond to, what happened if you just look at price action. Up here, this on this time frame was this 3-minute chart. This was a pretty serious bounce within the context of this trend. And you had the other short trigger here. The 50-14 has saved us a lot of trouble, because if the trend is reversing, what you'll generally see is the 14 coming right down to 0 and not quite crossing, bouncing up instead. It's a very powerful trigger, but it's one of the more complicated to watch, because if it doesn't make it up to, like in the short trigger, if it doesn't make it all the way up to the opposite 100 line, it's not enough of a correction to trust that it's going to have legs when it triggers. You need to see that 14 at the opposite meaning on the other side of where the 50 is. Here the 50 was below 0. You need to see that 14 get all the way up to the 100 line. The most important levels in the CCI are the 0 line and the 100 lines. The 100 lines are basically one standard deviation. They're a standard deviation away from the 50-period moving average. It's just like in a Bollinger Band. You can actually get the same triggers if you put Bollinger Bands on your charts. If you put a Bollinger Band on your chart, 50-period, it'll actually have price crossing the center of the Bollinger Band the same time that we're getting these 50 CCI triggers. It's the same thing. It's just that some people can read it more easily in Bollinger Bands. I can read it more easily when it's flattened out this way. So the 100 lines are the equivalent of the bands on a Bollinger Band. That's all I'm saying. They're important levels in reading the CCI. Yes, ma'am.
That 100 line is not drawn in a lot of charts.
I think maybe you have to blame Linda for that. Because it has something to do with how she printed it. Because this actually, this is exactly what I gave her to print out. So maybe they ran out of toner.
So you just it's an imaginary line in here, right?
You just put the sell under the lows that happened before it popped up to the 34 line? Is that where you're selling at?
Yeah. I mean, basically, it wasn't very long lasting. That was here. Wasn't that trigger lining up there? No, that was back up here. Yeah, that was here. Sorry.
I mean, you're looking to sell underneath.
Yeah, that's why. That was a deeper pullback. I'm standing at a weird angle here. Yeah, it was right here. And of course, if you're familiar with the fib work, you'd know that we would have resistance right there too. Because, it's just, we would have been working off this zone. But I promised I wouldn't get into the fib work too quickly, because I want you guys to understand the CCI first, because I'm sure it's done.
Use the 6 crossing the 0 as a trigger also.
Well, it's not as important as the 14 in the case of the fib, because what if the 6 crossed first and the 14 was on the wrong side? Then you might have the 14 bouncing off 0 and end up in a bad trade. Remember, the 14 is the slower one, so it's more likely that the 6 will cross first. And if you think that that's a 50-34Z and the 14's on the wrong side, that could be trouble. Okay, so that's your first assignment, everyone. Drawing your 100 lines. Yes, Mr.
I noticed you switch between linear and non-linear time. I mean, how do you make a decision of going from linear to 5 and 45 to the volume bars, which are non-linear?
We're going to get into that when I talk about the trading methodology itself and put it all together. Basically, a quick answer to that is that we've determined for our intraday trading, on some of the things that we trade, we found that the volume-based triggers are much more accurate. The thing about the volume-based triggers is that you have to spend a lot of time and getting into research on determining which volume factors to use. So that's why we don't have volume factors for everything. I've come up with, when I worked with Dharma, we came up actually with a whole set of volume triggers for the Russell. And I've modified those a bit since because the volume on the Russell was modified, has changed. We're working now also with volume figures on the mini Dow, which we change pretty often because we have a formula. Actually, someone who works with us has a formula for evaluating the volume of mini Dow trading in relation to ES and all the other minis, essentially. The point in using the volume-based triggers, or the reason that they're more accurate, is because the chart only moves when there's more trading activity. So, on a time-based chart, the trading could be totally flat. And the CCI is going to move anyway, or any indicator is going to move when you advance to the next bar. All oscillators are going to try to return to their zero lines. All oscillators. But if there's more interest in bringing the market down, it's moving faster to the downside, you're going to get a trigger more accurately and reliably on a volume-based chart. For stuff like, our longer-term stock trades and stuff, no, we're just using daily and weekly. Depends on what we're trading, but we'll go into, we'll go into specifics on that. Last trigger, and this one's my favorite, and I think a few people here know what it is. It is my favorite. You got it. 100-line bounce. 100-line bounce. Who here does have experience with Bollinger Bands? Anyone look at Bollinger Bands? Okay. You ever see, or Keltner channel is similar too. I actually like Keltner better than Bollinger. There's a thing on a Keltner channel called an upside running pattern or downside running pattern. That's when price actually skips outside the band and runs on the top of it. That's what you're seeing here. This is a short minus 100 line bounce. And what that means is the 50 CCI, remember, with Bollinger Bands or Keltners, you're actually looking at price. With the CCI line itself is our stand-in for price. It's the price information flattened out around the moving average. So you're actually seeing that price attempted to go back towards its 50-period moving average, the zero line, and got caught a standard deviation away from it. In other words, the strength of the downtrend was really good. What's our trigger here? Again, the 6 coming up to the zero line and then crossing back below. That tells us that, yeah, you know what? It actually is going to reject that minus 100 line. Why I really like these triggers? Here's another one. Here's a plus 100 line bounce for long side. Why I like those triggers is because 90% of the time, 85% of the time, it brings you a new swing high or low. In other words, 85% of the time, you get this minus 100 line bounce, you're going to make a new low. It's going to happen. You can count on it. Except for when it doesn't happen, because when it doesn't happen, it means that you're going to get a significant change in trend. Tells you something one way or the other, but it's the most reliable of the triggers.
So what's happening with the 50 line, Mark? I'm not quite following you there. It's crossing back below the negative 100 line?
Well, it didn't cross back below. It touched it. Do you guys have 100 lines for this one?
No.
I didn't have a chance to proof that.
Yeah, that's in there.
Oh, some people do and some don't? It must have run out of ink or something.
So the 50 line touched the 100?
Yeah, the 50 line touched the minus 100 here, see? That's the red line.
Okay.
And the 6 is our real short-term momentum. Cross and then cross back below. When it crosses back below, that's your trigger.
Crossing to zero.
Yeah. Sorry?
Zero line real faint with 100 in it.
Yeah, well, this is basically what my charts look like. Actually, it's kind of faint here too, but in the manual, I don't know how to print it out. Okay.
Mark 6 cross back below which? The 100?
No, the 0.
The 0. Got it.
Yeah.
So the triggers when the 6 crosses 0.
Right.
Crosses and zero.
No, that would be waiting. That would lose. You'd lose out on some of the trade. Yeah, but that's why those are my favorite, because you can sit back and go, okay, well, you got a 100 line bounce. You're at least going to get a new swing low. The thing is, it's not going to necessarily tell you how much of a new swing low you're going to get. As soon as you take out, in the case of this trade, As soon as you took out this swing low, here, see? As soon as you took that out, in other words, violated it, made a new swing low, that's all that trigger owed you. That's all the trigger owed you, was making a new swing low. That's why we combine it also with the fib work, because the fib work is going to give us a target off the trigger. We always have targets, so that's going to tell you how much of a swing low you may get from that point. But almost all the time, you will get a new swing lower high off the 100-line bounces. Now, a couple of nuances here on the 100-line bounces that we've discovered that you might want to take notes on too. This looks perfect right now. That looks like a perfect minus 100-line bounce. Intra-bar though, intra-bar, this is where it gets tricky, and this is what's really stupid. The stupid part of looking at still charts. That's why I like, my favorite part of this whole time together is going to be when we're looking at live stuff. Because all indicators can look different intra-bar. Okay? This may have actually popped, the 50 may have popped above the minus 100 line a little bit. And then you're like, well, is that a minus 100 line bounce or not? What has to happen now? The answer is, if that had popped above the minus 100 line, when the 6 crosses back down below 0, if the 50 is back down below the minus 100 line, it's still a minus 100 line bounce. Okay? In other words, by the time the 6 gives you the mechanical trigger, if the 50 is back in alignment for that to be a minus 100 line bounce, it's still a minus 100 line bounce. You don't have to worry about the fact that it crossed back above a little bit in the middle of the bar. Make sense? You want to follow that? Same with plus 100 line bounces. If the plus 100 line had been broken a little bit, 6 crosses down below 0. If when the 6 crosses above 0, the 50 is back above the plus 100 line, it's good to go as a plus 100 line bounce. Yes, sir?
Please, I'm sorry, it's a bit difficult to see the turbo from here, but you said the turbo has to go above 0?
Right, this is I didn't realize it wasn't showing up that well.
Yes.
It's here. Yeah. Yeah, it's right here, the 0 line. And it's not on it didn't print out properly? The 0?
It's here.
It's a 0.
You can guess pretty close.
0's there, but no hundreds.
Pardon?
0's there, but no hundreds?
They're here.
Oh, they're there on that one.
It's opposite, so you have hundreds left.
Okay.
It's not clear.
Okay, well, if I have to, when we look at live charts, I'll darken it if I need to. I'll darken the 0 line.
Drawn in.
What's up, John?
Just a quickie.
Sure.
If there is a little daylight,
Yeah.
either under the plus or, you know what I mean? A little light.
Yeah. If you can see the whites of its
A
eyes.
little whites of it.
Yeah.
Do you still consider it a 100 line?
Yeah, I'd like it to be as close as possible, though. And we'd want to see what's happening on the other time frames too.
Mark, if the 15 and 14 have made their downturn, but the 6 never crossed over 0, it is maybe a bounce, or
You gotta wait for the 6 to cross because it really.
the 6 has to cross.
Yeah, the 6 crosses the trigger. Yeah, because you know what's going to happen if it's going to be one of those like a minus 100 line bounce. Don just asked, what if everything else is in alignment but the 6 hasn't actually crossed yet? Well, that's how you can often see that the minus 100 line bounce, for example, is going to fail. Because the 6 will come right down. It's interesting to watch. You'll see this interesting if you don't have money on the line. But the 6 will come down to the 0 line and then suddenly and look like it's going to cross, and you're ready to push the button. And I'll say in the chat room, do not front run this. And then it bounces on the 0, and then the 50 breaks back up above. You're seeing a change in trend. Then you need to wait for the 6 to cross. Definitely. Those are the 4 triggers. Now, let's see, what do we have here? I'm getting a little concerned if these charts are not that legible. What we're looking for, though, what's this? This is one of our mini Dow charts. What we're looking for is for these triggers to occur on more than one time frame at a time.
100 lines on this one.
There are 100 lines on that one?
Or 0 lines, I apologize.
And 0 lines.
Yeah, you can see it on this one.
Okay. Someone go out and pinch Linda. Here's an example of what you were saying, by the way, Jeff, about seeing the whites of its eyes.
Right, exactly.
Yeah, because this, you see this short here? It would be kind of difficult, to call that a 50-14 exactly, because the 14 didn't quite make it to the plus 100 line, but it is a minus 100 line bounce. You actually had a series of them here. Okay? But you see, we also had a minus 100 line bounce on our next time frame. This is our YM trigger chart. On this day, we were using 350 volume, 700, and 2100. Yeah, it doesn't really matter because we changed these. I mean, that's actually a good set to use if you don't want to bother changing it. Yes, sir.
Just a refinement.
Sure.
On the 50-14, 14 must go to the 100 line?
Yeah.
Okay.
Yeah, now sometimes what you'll see, there are a few nuances to this, but it's not terribly complicated. Sometimes what you'll see, also intra-bar, is that the 14 actually came up and touched the plus 100 line. Just didn't close there. And then it reversed. And that's okay. That's still a 50-14 short. And again, that's why I like watching these charts, especially obviously the intraday charts, while we're actually, having live data feed them, because it's too easy to cheat too. I mean, how many of us have been to these seminars where, the guru stands there and goes, well, here was a trigger, and here was a trigger, and here was a trigger. Well, but did it really look like that while it was happening? Were you actually able to take advantage of that, or does it look really good in hindsight? And you can also fudge losing trades that way too. I mean, I work with some of the pros in doing this, in fudging. You could say, well, if that trade lost, that wasn't really a trigger. Believe me, intraday that looked like a trigger. So we have to be honest about it. Point is, going back to how I started off talking about this, we look for these triggers on multiple time frames because our goal is to buy or sell when the shorter term trend is rejoining the longer term trend. A plus 100 line bounce or minus 100 line bounce is an indication that there's been a minor pullback or corrective bounce within a trend. So if you can have a longer term chart, longer term trigger telling you, yes, the trend is going to continue, and you have a shorter term trigger telling you, you know what, the bounce against the trend is over, you have two time frames telling you trend's resuming, trend is being rejoined. If you only have these little short-term triggers with nothing else happening, here's another good set, by the way. Here's, we have a minus 100 line bounce here. Here's an example of a 50-34Z as long as that 6 was doing something intra-bar. You have to watch these in real time if you're trading intraday. If you're trading longer term, it's another story. What's up?
So your color is on your 14. What color are you using on your 14?
Blue.
Blue on the 14.
That's the blue here.
And the 6 is?
Yellow. Make them whatever you want.
Right, well, I'm just trying to get...
Okay. The only thing I recommend is that you have the 50. I like to have the 50 a thicker line just to be able to really quickly differentiate.